You're watching the latest IG commodity chat on IGTV, where we put your questions to the experts with me, Victoria Scholar. Today, we're focusing on base metals. Coming up in the next 30 minutes, recovery ready. Barclays says most commodities are now oversold and forecasts copper will rise above $6,500 a tonne by Q2. Zinc outperforms. The base metal is bucking weakness in the complex, posting its longest winning streak since January. And trading blows. The European mining sector slumped to the lowest level since July 2017. Glencore and Antofagasta are underperforming amid trade war tensions. Joining me today around the table is Daniel Lacalle. He's a Spanish economist and global influencer. He has more than 25 years of experience in the energy and finance sector, with a background as a global economics professor and a financial analyst. Daniel is also a best-selling author and collaborator with CNBC, Focus Economics and the Wall Street Journal. Also with me today is John Meyer, a partner and mining analyst at the investment firm SP Angel. John has been ranked as the #1 UK small caps metal and mining analyst 8 times throughout his career by Extel. Among his past positions, John worked for Goldman Sachs, SocGen and Montague Mining Finance. Now, our guests are here to help you understand and trade the base metals markets. So please send us your questions. It's really easy. You can post them on Twitter using hashtag #IGCommodityChat, or you can send us your questions throughout the live show by going to the IG community. Head to the base metals blog post found on the homepage. Now, anyone can leave a question using the comments section at the bottom of the page, which we'll put to our guests during this show. Now, how is Chinese demand affecting base metals? We spoke to Brock Silvers, Managing Director at Kaiwan Capital, to get his insights.
Right. Well, China has really been one of the primary drivers for base metals for several years. But the real question isn't how the trade war will affect the base metals markets, but how a softening Chinese economy as a whole will affect those markets. And the Chinese economy now has issues that extend well beyond trade. What I would say is 2019 looks like it will be a difficult year for China. The slowdown should continue, and that means continuing softness for base metals.
Now, Daniel, I wanted to start with you and pick up with what Brock was just saying there. I wanted to talk about the demand side, really, and how the Chinese economy is going to perform next year and how that might impact copper.
I completely agree with what we just heard, because it's not just that the Chinese economy is slowing down, changing the model from an industrially intensive to a consumer-led model, is overcapacity. We tend to forget the big impact on the price, because obviously commodities are priced at the marginal level of demand. Of overcapacity in the big consuming markets. And overcapacity in China is something that the government started to address and stopped addressing when the slowdown was started to be more evident. I think that if we look at the chart also of some of the commodities we're looking, for example, here at copper, it's striking, for example, the similarity of the chart with the yuan devaluation. And that is another factor that we need to take into account. So as the Chinese government tries to tackle its imbalances and its risks in the financial sector by devaluing, it also hurts the economy more than what they think that it benefits it. Therefore, we need to pay a lot of attention to the yuan relative to the dollar, because it does a lot to the pricing of commodities, and because it is the way in which China exports disinflation to the rest of the world. So on one side, the demand side is slowing down. On the other side, the monetary factors are not helping in the pricing. And we need to also think about how the Chinese government is going to address the issue of overcapacity, which it is not addressing right now properly.
Right, now we're certainly going to get to the US dollar later in the show in a bit more detail. But John, I know you heard in the headlines there we were talking about Barclays saying that the commodities in general are oversold and copper could move up to $6,550 a tonne by Q2 next year. What do you think of that?
Well, I hate to agree with Barclays on anything, but in this case, it looks like they're probably right. I mean, notwithstanding some short-term trading, which clearly we're seeing today with commodity markets moving down a bit. Yes, we do see China may be slowing its growth, but the key word there is growth. It is still a very large economy. It is still growing at an extraordinary pace, and so it will still be using more commodities going forwards than it was last year and the year before that, unless there is some calamity and outright crash in China. And actually, the Chinese authorities seem to be pretty good at improving liquidity when they need to. I think personally they're going to capitulate in some way. They won't want to appear to do that, but they'll capitulate to Donald Trump because it would be silly not to. And they need to come up with some agreement, although clearly the latest tariff negotiations have not gone that well because they haven't come to any agreement yet, and they're, as politicians like to do, they're kicking the can down the road a bit.
So Daniel, how do you see those trade tensions playing out, especially when it comes to the copper market? And right now the moves that we're seeing, are they fundamental or are they sentimental?
I think they're a little bit sentimental. I think that we're putting too big attention on the issue of trade wars, and they're not the driver, in my opinion. I think that the challenges of between China and the United States come from something completely different, which is that we have seen a massive increase in the years of easy money, of productive capacity in the OECD and in emerging markets, with the idea of selling to China, while China was also increasing its productive capacity in order to sell to the United States. So what ends up happening is that we've seen a massive increase in overcapacity in all these countries. And yes, obviously demand is growing. We completely agree with that. But the problem is that the supply-demand scenario doesn't improve even though demand is growing, because the level of excess capacity, and therefore what leads the price, which is marginal demand, is softened. And the challenge that I find is not on trade war, but more on trade itself, trade growth, because it comes to also the fact that if you have a sort of slowing down economy in the United States, slightly slower for 2019, slightly slower in China, you cannot offset the reduction in growth. And we've seen a 10% reduction in growth expectations. We tend to talk about percentages over the GDP. So more than 10% reduction in demand, in growth expectations for next year. So we need to pay attention to that. I think that it's going to be difficult to see a global trade growth be as robust as it was in the early 2000s.
Now, we've talked a lot about demand so far, but what about the supply side? I spoke to one analyst who said there's a big lack of new supplies. So what's production in copper been like this year, and what's your outlook for next year?
Well, there is definitely a lack of new mines coming into play, particularly in the copper sector. But in fact, we can look across all the metals, and they haven't been discovering mines the way they used to. They haven't been financing them or building them. And so longer term, there's this bigger problem sort of storing itself up. Short term, if we look at copper, for example, actually they had a good year in mining, in that there weren't any material strikes, there were no big stoppages for accidental stoppages or anything like that. And so that was quite unusual. Normally we see more disruption that hits the supply models, and so 2008 has been unusual. So there's a bit more copper around than we would have expected, and that's fine. That's what's depressing the price right now.
Now, Daniel, we've had a question from our IG community from earlier, and it's about Dr. Copper. We know it's the base metal with a PhD in economics. So is copper as good a bellwether indicator as people previously thought?
It is actually quite a good one. More than about a recession or a period of high growth, it is more an indicator of slowing down or small improvement. I think that also another factor that has impacted copper as the sort of bellwether of how the economy is doing is how much money there is in China in debt that is backed by copper, also by gold. And this such large amount. It's almost impossible to have a clear picture of how much it is, but it's such a large amount that what ends up happening is that when you have a domino effect of what we said about before, the yuan devaluation, margin calls start to happen. You have to sell, and then you have to sell the underlying. So you impact the price. So probably, as you were saying, John, the supply-demand picture is not that bad compared to what the price has done. But we tend to forget that problem of the excessive leverage. So it is a clear indicator of global slowdown, but it's not an indicator of, let's say, recession or even of long-term robust growth.
All right, now let's get more on where next for copper in 2019. Michael McNeely is the CEO at Metal Tiger and gives his take.
I see that there's a structural deficit which is developing in copper currently. It may come sooner than expected. A lot of analysts have predicted 2020. It could occur as soon as next year. It really depends on the supply and demand metrics. There is a huge lack of new supply which is coming on. Obviously we have had, which will change a lot of the analyst forecasts, some very interesting hits recently from BHP, as well as there's a lot of speculation over what Rio's found in the Patterson region. But generally speaking, it's getting more and more expensive to bring these into production, and we're getting lower and lower grades. I like to focus on the supply side because everybody talks about this electric vehicle revolution, and obviously we all know that as technology improves, manufacturers are always looking for ways to actually lower the cost of the metal that they're putting into the materials. And so I do think some of that demand that people are forecasting will ultimately end up being lower. But all in all, the supply side is going to mean that we're going to have a structural deficit. And I think when the Chinese stop selling the metal right now, I think we will see a nice spike at some point next year in the price. Well, of course, base metals are quoted on the London Metal Exchange in dollars, so there's always a correlation in terms of that. In terms of standard deviations, I mean, I think that is one of the higher standard deviations that actually impacts the movement of copper prices and base metals in general. And obviously then there's also the price of oil. So it does impact it. So clearly interest rates rising in the United States, pushing up the value of the dollar has had a bit of an impact in terms of the price of copper.
Now, our guests are here to help you understand and trade the base metals markets. So please send us your questions. It's really easy. You can post them on Twitter using hashtag #IGCommodityChat, or you can send our questions through the live show by going to the IG community. Head to the base metals blog post found on the homepage. Anyone can leave a question using comments in the bottom of the page, which we will put direct to our guests throughout the show. Now, there were lots of interesting points there from Mike, and I want to pick up on a few of those. But firstly, we had a question just sent through to us now from Peter Sainsbury. He says, which base metal is least exposed to a slowdown in China?
That's an interesting question. Look, I think we've talked about the fundamentals, and as an analyst, I love to work off the fundamentals, and I certainly think they work in the longer term. But short-term moves are often more sentiment-driven, and I think the short-term move we're seeing at the moment is more to do with the weaponization of copper, if I can use that term. We saw oil weaponized, was it a year ago? Now I think copper is being hit. I think some of this is down to the arrest of the Top Mountain Highway in China. But if we go back to the point being made, I think that it's the better metals to go for are the ones that are smaller, actually. And I would still look to tin, zinc, and nickel. Let's put aside copper and aluminium for now, because I think there are other forces acting on them. And I think Daniel will probably talk more about zinc. It's difficult to invest in tin, but it's very hard to find new tin supply. People have been worried about new tin coming out of Myanmar, for example, but they really can't ramp that up very much. So where are we going to get the tin from? And Rio Tinto a year ago put out a presentation with work done from MIT in the States, suggesting that tin was going to be one of the big success stories in the battery metals revolution, because you need a lot of tin solder for connecting all those batteries and solar cells and things to do with wind farms and all of that. But if we go away from the base metals, we can also look to some of the other industrial minerals, so lithium, vanadium, niobium, the rare earths and stuff like that. So let's not confine ourselves just to base metals, but of course, if you're trading on the LME, I guess that's where you've got to be. So tin, nickel, zinc. We're a little bit cautious in the short term on nickel, because Indonesia has just granted licenses for 2 of its nickel producers to resume ore exports. And that's as a reward for building new smelting and refinery supply in Indonesia. So that will bring a little bit more nickel into the market. But we've seen stocks coming back quite fast in nickel. So it's a situation which I don't think the Indonesians are going to disrupt that for too long.
Now, Daniel, I wanted to pick up on a couple of things that Mike said in that sound clip there, and one of them was about the US dollar. We've seen it appreciate by around 10% since those lows in February. Of course, on the LME, these base metals are priced in dollars, so it's clearly a headwind. What's your outlook for the greenback?
Well, the dollar is not strengthening. If you look at the chart on instead of a year basis, you look at it on a 5 or on a 10-year basis, it is basically in the range of the last 5 years. So
you're not concerned about this rise?
I'm not concerned about the dollar. I'm concerned about the global slowdown. And we tend to use subterfuge like the dollar strength, which in fact is not because the dollar is strengthening, but because the yuan is devaluing and emerging market currencies are devaluing. So it's weakening of other currencies. So think about this. Too many countries are trying to solve their imbalances through monetary easing, through devaluation. So, and you've seen it in Turkey, you've seen it in Argentina, you've seen it all over the world. If that continues to happen, that is a much larger effect on demand than what we believe, because we tend to believe as economists that devaluations are a tool for growth, and they're not, especially when so many countries are undertaking them.
So on your concerns about a recession, we had a question from our IG community about this Treasury curve inversion that we've seen this week. Clearly it's seen by many as a precursor to a recession. You know, it's preceded a recession, every recession in fact, since World War II. And so this question is asking whether there are any correlating indicators in the base metal market either now or looking to the future which could serve as a confirmation to that.
Not of a recession, but of a disinflationary process. The flattening of the yield curve is not always an indicator of recession, but is always an indicator of disinflation. And it coincides precisely with the long-term curve of many of the base metals. You've seen many of them lose between $3 to $5 in the last years, all throughout the curve. So I think that, and also in oil, I think that is also an important factor.
Well, that was another question actually we had from our community. Is there a correlation between oil prices and base metal prices, either positive or negative? Obviously, there's a lot of noise going on in the oil market this week amid OPEC. We've seen prices decline significantly. A lot of volatility likely to be seen into the weekend.
There is a strong correlation. The correlation tends to come when the driver is demand growth. When demand growth is taken for granted, and on the impact or the focus of investors is on supply challenges, etc., then there is changes in the correlation. But when the whole debate is about demand growth, which is I think what is happening right now, the correlation is very, very significant. And I think that is the reason why today miners that have very little to do with oil are falling in the stock market just as much as the energy-related stocks.
Now, John, earlier you talked about some of the battery metals and the potential successes that we could see in those going forward. Of course, a lot of that is linked to the electric car revolution. We had a quick look at a Tesla, the makeup of a Tesla, before going on air, and there's a whole host of base metals in there: copper, aluminium, nickel, and that's not even talking about the infrastructure for charging as well, where a lot of copper is needed as well. So I'm wondering how fundamental it is for the base metals complex, this move from gasoline and diesel towards electric.
Well, it's not fundamental right now. It's more sentimental than anything else. But going forwards, sure, it's going to be very fundamental. Because, yes, there's a lot of nickel in a Tesla battery pack. It's a particularly heavy battery. The weight of the lithium is very little, because lithium is just a very light metal. And it's very hard to replace something like nickel. It's particularly good in a corrosive environment. You see it in battery packs, but you also see it in fuel cells and other sorts of electronic devices. And no one's come up with anything that really is economically any better than nickel. So that's important. And then, of course, we can look at a whole host of other metals, but they tend to be in the rare earth category, so niobium for the permanent magnets. And Tesla at last is saying they're going to use permanent magnets, whereas they were trying very hard not to. Let's not forget the cobalt. Still difficult to produce batteries without reasonable amounts of cobalt in there. And although they're going to reduce that cobalt content, they will still be requiring more than is probably in the world supply right now. And let's face it, Glencore's share price has come down partly because of problems to do with exporting cobalt with uranium. So that was a bit radioactive and perhaps something that was not being caught up before. And they've got other trouble to do with dealing with the DRC and certain people in that jurisdiction. So the US Department of Justice is having a little investigation in that department. Mm-hmm. So there are other issues that are affecting some of these miners. But I always find it interesting when the oil price drops and all the miners fall. Really, they shouldn't be, because actually they spend a lot of money on oil. You know, energy is normally about a third of their cost base. So in reality, if you're reducing the price of oil, the profits should be going up. But of course, it affects the funds in the market. So there's a flow of funds argument that tends to cause these things to fall. And then later on, when the profits are seen to rise, then they pick up again.
All right, now I want to get into some of those investment opportunities in the stocks. I know you mentioned Glencore there, for example, and we'll get onto that in a second. But just before we do, Daniel, I wanted to ask you about the commodities supercycle, because we saw that 300% rise between 2000 and 2007. Then it had a blip after the financial crisis, managed to claw back up to above those highs in 2011, and now it's down around 30%. So is this a pause, or is that the peak and we're moving into a down phase?
I think that the second phase of that commodity supercycle was entirely thanks to Dr. Bernanke, QE1 and QE2 particularly, which brought massive inflation in the commodity complex and obviously the dollar down. I think that what we are seeing is not a reversal of that cycle, but a normalization. If you take in real terms what commodities have done in the last 50 years, actually, if you take the periods of high recession, what you should expect is an increase with the levels of real GDP growth. And that's, in my opinion, where you're likely to see the next phase. So you can expect an environment in which, if there is a big concern about disinflation and global slowdown next year, obviously prices will continue to moderate, but the process in the longer term, which is back to what John was mentioning, is likely to be of trending with real GDP growth. The monetary factors, for anyone that's listening to us and that thinks, oh, but central banks are going to come back and give us another 5-year party on commodities, have stopped working. And the reason why they've stopped working is because they become part of the liquidity. So as an investor in commodities, what you have to go back is to the fantastic fundamentals and the people that actually know about what is happening. And less about Mr. Kuroda, Mr. Draghi, or Mr. Powell are going to give us a party.
All right, now our guests are here to help you understand and trade the base metals markets. So please send us your questions. It's really easy. You can post them on Twitter using hashtag #IGCommodityChat, or you can send through your questions throughout the live show by going to the IG community. Head to the base metals blog post page found on the homepage. Anyone can leave a question using the comments section at the bottom of the page, which we will put to our guests throughout the show. Now we're going to use the final few minutes of the show to talk about potential investment opportunities. Now, John, I know that one that you've been looking at is tin. We saw it slump to a 2-year low in November, but it appears to have been making a rather miraculous recovery in the last few days, up around 5% in 6 sessions or so. So what's your outlook for tin?
Tin has been under pressure for some years. I mean, it's still a highly valued commodity at $20,000 a ton. It's worth more than 3 times the price of copper, for example. And yet it's relatively cheap to produce, but that's when you find it. You tend to find it in sensible grades. So where do you go? And the difficulty is finding new tin mines. So we are in touch with a few companies that are trying to do that. For example, Strongbow Minerals, they're listed in Canada. They want to reopen the South Crofty tin mine in the UK. That's a difficult process. It's full of water. The pumping, it's going to cost $10–15 million just to pump the water out. So where else do we go? You could go to Burma, but the laws are not good, so it's really very difficult to invest in Burma, or Myanmar as we call it, and again there are sanctions on that nation at the moment. So we're looking for people who are exploring. So Strategic Minerals, which is one of our clients, they in fact they had some unexpected but very good tin results, or tin and tungsten results, at their Redmoor project in Cornwall. I went to see that a couple of weeks ago. They said, look, this is looking interesting, you should go down there. In fact, if anything, I think they were underselling it. And when we got there, we found a very excited team of geologists, and a week later they produced some pretty good results. So that's looking interesting. But it is very hard to invest in this metal.
And Daniel, I know one of your calls is long zinc, and it's actually in the longest winning streak since January. And the backwardation in the market is actually now at a 20-year high. And we had a question from the IG community about just that, and they're wondering whether this backwardation is physical or is it speculative, and what's it telling us about the market?
Backwardation is always speculative, but what we need to think is whether it is rightly speculative, whether it is based on something that is correct. And I think that what the chart is showing, and the reason why it's recovered quite nicely, is because the supply-demand scenario is actually quite robust. I actually like that, even having a bearish view on global demand, and even having a, let's say, even if you put your sensitivity analysis on the supply and demand expectations, that you're not going to find yourself in an overcapacity. Some of these of the base metals go very, very quickly into overcapacity, into oversupply. No,
like aluminium, or
like aluminium, particularly aluminium. And in the case of zinc, the reason why I like it is because that is not the case. No, even if I have a 10–12% reduction in demand growth, I don't find myself in an oversupply situation in terms of estimates. The other thing is that obviously it is much less exposed to the risk that we mentioned before, which is the debt backed by a commodity problem in China. And it is the least exposed to the risk of the yuan devaluation. So that's the reason why I sort of prefer it on a relative basis. It's demand supply is actually the most robust, in my opinion.
And John, what about from a stocks perspective? Are there any stocks that really catch your mind as a buy opportunity in this sector? I know you pointed to Bushveld Minerals, also Macango and Arc Minerals in the small caps, and then I think you quite like Glencore in the large caps. Is that right?
Well, I do like Glencore, and in fact Glencore was one of the big miners that was running around hoovering up the smaller zinc producers or zinc projects. And actually, when we looked at the valuations of the acquisitions of those zinc assets, they were extraordinary. So Anglo-American, Vedanta, Glencore, just buying up everything at almost any price. But clearly they were right, because the zinc price then carried on going up. Glencore squeezed the market by restricting the supply when the price looked a bit weak. And actually the price has continued to remain relatively strong. So they're making very good money out of that as a business. It doesn't really suit BHP and Rio Tinto, because they're really much bigger companies. They're playing in iron ore and aluminium, which are bigger markets. But when it comes down to stock-specific ideas, we love things which are new developments, exciting discoveries. Arc Minerals with copper and cobalt in Zambia.
Got the chart here of the Arc Minerals.
Mm-hmm.
Yeah, and the drill results coming out of this one just seem to get better and better. They're producing 2–3% copper equivalent. That's the copper in with the cobalt, and that's right at surface. So it's very economic by the looks of things. There's still some risk in there. We don't know the metallurgical recovery rates. They will hopefully start production later this year, early next year, something like that, because they have a sort of test trial plant at site. And that's pretty interesting. That's on an extension of what we see as the Zambian copper belt, which has produced an awful lot of copper over the years, and that's interesting. Again, we should move on to bushveld minerals. Vanadium is not an LME metal, but the vanadium price has been very, very high. It's just coming off its peak, which was an extraordinary price level. In fact, I think that must be that's the bushveld price. But if you looked at the vanadium price, you see it's just coming off. The price has risen about 5 times from where it was a couple of years ago, which you don't see very often, but that's because there is a fundamental shortage. There's a fundamental shortage of supply, and also there's a significant increase in demand, because China said, well, we've got to stop building buildings in China with rubbish rebar. It needs to be strengthened with vanadium, as is done everywhere else in the world. Otherwise, the next time there's an earthquake, everything will collapse again. So the Chinese have increased the consumption there on the vanadium. And at the same time, their anti-pollution policies, this green shield drive, has caused them to reduce the processing of vanadium slag in China. Now, some of that is being done elsewhere, but some of that's being cut out of the market. So they're not producing vanadium from stone coal, which is rubbish quality coal, and they should never have been doing that anyway. And so it's caused this disconnect in the market, and I don't think there is any real spare vanadium supply out there.
All right, now that's all we have time for today. Thank you so much to my guests, Daniel Lacalle and John Meyer. And you can continue the discussion at the IG community on the IG commodity chat thread. You can find out all about it at community.ig.com. Now, our next live show is tomorrow at 12:30 p.m. We'll be breaking the US non-farm payrolls report for November. Expectations are for a reading of 195,000. My colleague Jeremy Naylor will be joined by our guests Brian Noble from tradernoble.com and Chris Beecham, IG's Chief Market Analyst. We'll be streaming live across IG.com, YouTube, Twitter and Facebook. So join the debate and ask your questions using hashtag IG Commodity Chat. See you then.